Hello investors, welcome to the channel. Here I talk about long-term investing in companies that pay a dividend. This is known as dividend growth investing. My name is Michael, and today we're going to start off with looking at how the market ended for the week and then look at stock futures. Just taking a quick look at the major indices for the week. For the S&P 500 index, it is up 1.5%. For the NASDAQ index, it is up 4.62%. And lastly, for the Dow Jones Index, it is up 0.32%. For my American viewers, happy 4th of July weekend. Please remember to take precautions when celebrating this holiday weekend. Since it is a holiday weekend, the markets are only experiencing 4 trading days this week. As of this recording, the markets are continuing to surge this past week as a result of easing quarantine restrictions. The easing of quarantine restrictions have resulted in the rehiring of people for multiple businesses. This means that jobs are coming back and therefore the market is looking to recover. Let's take a look at some of the news that have been affecting the markets this past week. If we take a look over here, as of this recording, there has been a confirmation of over 12 million total confirmed cases of COVID-19. With the easing of quarantine restrictions, it's logical to think that there will be a substantial rise in COVID cases after this week. If you're smart, then you'll practice social distancing and avoid people as much as possible to avoid getting infected. However, I imagine that this will most likely not happen within the US, as large sums of people will not follow these quarantine guidelines in the US due to the holiday festivities. Therefore, it is most likely that we will soon see a huge spike in the amount of cases of the virus in the following weeks. In response, it is most likely to be seen that this increase in viral cases will cause another sell-off in the stock market. This website is organized by Johns Hopkins University, a well-respected and established institution of education. As of this recording, the university has counted over 12 million total confirmed cases in the world. In addition, they have counted over 500,000 confirmed deaths and have shown that the numbers only continue to increase exponentially rather than flatten out as seen in the confirmed and logarithmic graph. Given the state of affairs, it appears that this pandemic will continue to affect the entire world until a vaccine is manufactured, distributed, and herd immunity kicks in to protect the population. Now, the scary thing to note about this virus is who it affects the most. According to the CDC, there are 2 groups of people who are severely disadvantaged by COVID-19. These people are considered as older adults and people who have underlying medical conditions. As we can see here, this infographic right here shows that people who have been infected by the virus, the likelihood of them being hospitalized increases as age increases. This infographic right here says 8 out of 10 COVID deaths have been reported in people who are 65 years or older. In addition, if you have underlying medical conditions such as CKD, COPD, obesity, sickle cell, or type 2 diabetes, you're also severely at risk. So it looks like people who are healthy and young aren't nearly as detrimentally affected by this virus as people who are older and have underlying medical conditions. However, this doesn't mean that young people should be outside and mingling with other people. They should still protect themselves, wear masks, and practice social distancing for as much as possible, because these people can catch the disease, may not show any symptoms, and then infect others. Now, let's talk about banks. As many should know, banks are financial institutions that accept deposits and recurring accounts from people. Banks participate in lending activities which can be performed directly or indirectly through capital markets. Many people right now are worried that banks may fail due to the stress of the pandemic causing multiple bankruptcies and housing foreclosures. Many people are also afraid that US banks will suffer the same fate as they did in the previous recession concerning the housing bubble crisis. As a result, a lot of banks are well priced a lot lower than their intrinsic value. Due to this evaluation, some of these banks, which have stock, such as Wells Fargo, have cut their dividend. However, this is most likely an overreaction, and therefore, this situation presents a good buying opportunity in the financial sector. Now, the federal government has looked into the financial sector, specifically banks, and they performed an annual stress test. From the annual stress test, the federal government has concluded that the nation's biggest banks are healthy, though they may have some concerns of suffering some losses due to the pandemic. However, these losses are not large enough to cause major concerns and therefore are seen as safe investments. In addition, according to this article, banks most likely won't be able to make payouts that are greater than their average quarterly profits from the 4 most recent quarters. Finally, the federal government has barred banks from buyback shares in the third quarter, even though buybacks are the main way the U.S. banks return capital to shareholders. This is important because the main ways that banks give back to their investors is through dividends and buybacks. Giving out dividends and doing buybacks decreases the money supply that banks hold, and this is very bad during a recession. If anything, right now, banks are in dire need of a lot of cash, something which the Federal Reserve cannot continue to print out money because this will cause a rise in inflation. Now, let's move onward to my portfolio to see how it's doing this week. Looking at the past year, my portfolio is down 15.47%, causing a loss of about $1,070. Looking at the past quarter, my portfolio is up 6.87%, causing a gain of about $565. Looking at the past month, my portfolio is down 6.10%, causing a loss of about $570. Looking at the past week, my portfolio is down 0.55%, causing a loss of about $49. And finally, looking at the past day, my portfolio is up 1.96%, causing a gain of about $170. Overall, my portfolio is down this week. Luckily, the dividends I'm earning through this portfolio is still here, and in fact, over time, we can see that it's actually increasing. This earned dividends number is the reason for investing in this kind of portfolio, because even in market downturns, this number will continue to go up regardless of what happens. And the only reason for this number to ever stop moving upward is if all the companies I invest in suddenly stop paying dividends. So, for this week, let's take a look at the amount of dividend that I've earned from various companies, which I can use to reinvest in my portfolio. Looking here, I earned 1 cent from Marley Corporation, 18 cents from Automatic Data Processing, 2 cents from Brown-Forman, 2 cents from Brown-Forman, 22 cents from Coca-Cola, $1.55 from Genuine Parts, 26 cents from Hewlett-Packard, 2 cents from Nike, 15 cents from PPL Corporation, 1 cent from BIP, 11 cents from BIP, 3 cents from BEP, 5 cents from BEP, 9 cents from BEP, 14 cents from Iron Mountain, 33 cents from Kimberly-Clark Corporation, 11 cents from Rogers Communications, 8 cents from Spire Corporation, 5 cents from TELUS Corporation, and finally, $3.09 from Iron Mountain. These dividends that I earned are a result of me owning shares of each company. This is money that I did not have to put any effort into earning besides clicking a few buttons to buy shares. Essentially, I'm earning money while I sleep. This is referred to as passive income. Earnings which are derived from an enterprise like a rental property or a company that require little to no effort to earn and maintain. Although these amounts may seem small, every little bit helps and will eventually snowball into something bigger through compounded interest. In addition, let's take a look at how my portfolio has performed this past month. If we take a look at this spreadsheet, I have tracked my dividend for this entire year. On this graph right here, you can see the monthly dividends that I have generated through this portfolio. In blue is the amount of dividends that I earned last year through this portfolio, and in red is the amount of dividends that I've earned per month for this year. And in June of 2020, I earned about $30.83, which is about 3 times as much as what I earned last year. So my earning capability through this portfolio has 3x itself. Looking down here, I also graphed the quarterly dividend because we just ended quarter 2 of 2020. And as we can see here, when my portfolio first started, it only generated about $2.50, then $28, then $39, then $58. Last quarter, it generated $90, and this quarter, it broke over $100. So that's really good. Basically, I earned about $33 a month in quarter 2 of 2020. So that's really great to see. And I can't wait for this portfolio to generate even more income when I put in even more money through this Roth IRA. This concludes the update portion of my portfolio. Thank you so much for watching this video until the end. If you like this video, then please give it a thumbs up as it will help the channel grow immensely. If you have any comments or questions, then leave them down below in the video and I'll do my best to personally address it either in the comments or answer it in future videos. I greatly appreciate everyone watching my videos and I hope to speak to you all again very soon.